Hello, future billionaires. Welcome back to another episode of the Invest Like a Billionaire podcast. We've got a really great episode for you today. This was an interview that we had with Ryan Smith. He's the co-founder of Elevation Capital, and it was a really fun conversation. I've known Ryan for a little bit of time and just really appreciate his perspectives. He shares a lot on, what it's been like. He focuses on self-storage, mobile home parks. He's been investing for a long time and kind of through multiple periods of these cycles. And so really kind of gives some great perspective on how to invest at different parts of the economic cycle. He shares his perspectives on, the macro environment right now and, why he's not really concerned or even paying that much attention to the headlines with interest rates and, inflation and recession, all these things going on, and shares why. And then finally, he shares what he's looking at in his verticals of self-storage and mobile home parks and what's the latest going on in those asset classes. So you definitely want to tune into this episode. Ryan shares a lot of wisdom, has a unique investment philosophy. I think you're going to enjoy it. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Welcome back to the Invest Like a Billionaire podcast. I am your co-host, Ben Fraser, joined by fellow co-host Bob Fraser. And today we've got a really special guest. I'm very excited for this interview with Ryan Smith. He is the co-founder of Elevation Capital Group. And him and his wife started this firm many years ago. And I guess with a backstory there, but they have scaled it very effectively over the past years and now have over 20,000 units in mobile home parks as self-storage assets. And I met Ryan probably a year or two ago and really just appreciated who he is. And I've heard him on other podcasts and just really loved his perspective on investing. And so I wanted to bring him in. So I really wanted to hear what you're doing in this kind of current market cycle, kind of see how you view the macro picture. I think you have a really unique perspective on just the macro. And then I also want to get the updates on what's going on in self-storage and mobile home parks. Obviously, there's, things going on in the broader environment that people are concerned about, but would love to just hear your perspective. So Ryan, thanks for coming on the show and looking forward to this chat.
Thanks for having me. I've been looking forward to it.
Yeah. So maybe start off just a little bit with the origin story. For those that don't know who you are, and it's always fun. It's sometimes hard to get people like you on podcasts because you're actually operating a very successful and a large business. But I feel like the perspectives that you have are just really valuable. So share a little bit of just who you are for those that maybe don't know your story.
Yeah. So just, I guess, succinctly, I'm kind of entrepreneurial, grew up in a real estate family, very blue collar. So I had a awareness of real estate at a young age. I was scraping wallpaper, digging trenches. I think the worst thing I ever did was replace the wax ring on a toilet. I distinctly remember that as a young person. So I understood what real estate was at a young age. Ended up doing all my father's underwriting and his financial modeling. And as a teenager, because my dad was ADD, ADHD, wonderful guy. Today's his birthday, actually. We're going to celebrate tonight. But it was kind of my role in the family business to help do the modeling and the forecasting. So kind of parallel to this, I started learning to code when I was 8, kind of a nerd in a way. And so ended up learning 13 languages, computer languages. And I would basically code apps for any business owner in town that I'd go to a business, with my family, with my mom, my dad, or school, and I'd see just a plain solution that software could solve. I'd write an app, put it on a disk, hand it to them and say, I think this will is the problem. So I liked writing software. So I took it upon myself to build an application that my dad could use for his business that did all of his financial modeling without needing me. So it was kind of selfish in a way. And I endeavored to one day leave the home. But in short, I spent about 4 months. He didn't know about it, and I coded this app in Borland C, and just presented it to him. He was pretty blown away. It worked, and so he told a friend who told a friend. And so anyway, in short, I had about 130,000 users of my software, mostly mom and pops, using my software to evaluate their investments globally. Ended up selling that company. But it provided, in the time that I built it up, it was about a 10-year span, made a considerable amount of money off that software company. Took that income, with my wife, Jamie, who I connected with her along the way, and she has a significant property management background. So she and I convinced her to not become a lawyer and to join me in building a business. And so she and I kind of linked arms, kind of hand in hand, and started to build the business. And we started with single family residential. We used the capital we had, or earned and saved, the software tool that I had built. And we started building a portfolio of residential, which we built. We bought about 30 houses in our early 20s. So about 20 years ago, in and around Orlando, long-term, mindset. We found it wasn't that scalable. And so we started looking at, businesses that accomplished for us 4 things. And we wanted cash flow, capital appreciation, tax benefits. And then, it could be said a lot of different ways: low beta, low correlation, cycle resiliency. It's kind of all the same thing. So we wanted off the roller coaster ride of economic cycles, as much as we can. I mean, sometimes you'll see recession proof, and I'm a little dubious over those kind of claims, but anyway, those were the 4 things we wanted. So we spent a long weekend. We created we evaluated every asset class we could think of on our dining room table, and kind of put the models on the table at the end of the weekend. And we evaluated everything. I mean, hotels, motels, retail, office, the gamut. And the 2 that seemed to be the most compelling based on our rudimentary analysis was storage and mobile home parks. And so we started building a portfolio around that time. In the first 6-7 years, it was all our own money. And then we started our first fund in 2010.
Awesome. Very cool. So talk a little bit before we kind of get into the asset classes. I'd love to kind of spend time more at the macro level, because I think one of the unique things that you kind of bring to the space, and one, being in real estate investing for a long time, but 2, just, you're not just a pure operator. You also have a lot of great perspectives on just the macro environment. And so, talk a little bit about what you're kind of seeing this cycle. What's your perspective on where we're at in the economic cycle? How is that changing, if at all, your investment thesis? Yeah, what's kind of, what's your plan strategy this year and the next year, you say right now?
Sure. And so, our views, I would say our goal in life is to consistently make things more simple, and as I've gotten older, I can say in a sentence what used to take me a lot longer to say. It was kind of like I think Mark Twain, if I had more time, I would have written less. So to us, we're pretty simple in our view. We want to own really quality assets. And for what it's worth, there's far fewer quality assets than are claimed to be quality assets. So there just aren't that many quality assets out there. And not many of them come up for sale in any given year. So that's kind of a limited supply of quality assets, but that's what we want to buy: quality. And I can go more into detail on what that is, but in short, we want to own quality. And then, what we think a lot of people, everybody has their different motivations and reasons for doing things. But for us, if you buy something really well located that's quality, you want to hold it long term. So you want to buy quality, you want to hold long term. And that's across many cycles. The water will go out, the water will come in. it ebbs and flows, and there's benefits to those cycles, but we're not trying to time, time any particular cycle. So we're not overly, opportunistic in that way. So in short, we want to buy quality, hold it long term. And the primary reason you're not able to hold the property long term, or you have forced sales, is you have too much debt. Debt is the motivating factor for a kind of a forced liquidation in most cases. So we use very low leverage. We have a portfolio of about 300 million in assets right now that has about 40% leverage on it. So it's pretty low. So we want to own quality, hold long term, have low debt, and then optimize as cycles give us the ability to. But that's kind of in short, that's kind of our view of things.
Got it. Yeah, so definitely a unique investment thesis, especially amidst all the we talked about in previous podcasts, real estate syndication bubble, where everyone and their mom who saw someone on Instagram get rich through real estate decided they could go syndicate and use high leverage, bridge debt, and other things to get into the space, but ultimately kind of set themselves up for failure. One of the things that I wanted just to dive into a little bit, this is something I actually heard you say on another podcast that was a pretty simple kind of framework, but for me, it was very helpful to understand, as you're investing through economic cycles, this kind of longer term mindset. And I think right now as investors, people are a little bit scared, right? They're just a little hesitant. They're wanting to just sit on cash and wait to see what happens. And there is a good case to be made for, being a little more conservative, sitting on some cash and having an opportunity, fund. But we also have this arch nemesis called inflation that's eroding the value of our dollar. And one of the things that's really interesting, and I'm going to drop some knowledge back on you that you dropped a couple of years ago when I heard you. But one of the things you were talking about was, as you kind of go into these different cycles, and as you have, interest rate increases, like we're seeing right now, a lot of times that's due to a over exuberant economy, and they're trying to slow down the economy. And when that happens, a lot of times there's inflation, right? Because that's not in every cycle, but obviously in this cycle it is. And while you have the higher interest rates, that can put pressure on cap rates. So it may not be a good time to sell. That can, be a bad time to sell if you have to sell. But the inflation generally is going to be a benefit and a tailwind to those that are holding and owning the real assets like real estate. And then as the cycle kind of peaks and comes back around, as the economic slowdown occurs and they need to kind of juice the economy again, they can lower interest rates, which then obviously helps create more headroom on pricing and can put less pressure on cap rates, so values can kind of expand again. And meanwhile, you've had inflation that has kind of helped continue to force appreciation, and you can, as an owner of real assets, ride that. And then you can expand your NOI while that's happening. And then as, the multiples on that NOI increases, you can potentially sell at that point. So obviously a very, very kind of simple analysis and framework, but to me, it was really helpful as, it can be really hard to not get lost in the noise of what's happening, especially right now as we're kind of in the middle of this transition in the cycle, and we're seeing interest rates increase the fastest they've ever increased in history. I actually haven't checked, for probably right now, they're about to announce another 25 basis point increase. So it feels like all this, tightening of the noose a little bit for a lot of people. And then to the earlier point, a lot of people bought real estate with bad debt that's going to be maturing this year and next year with floating interest rates and very aggressive business plans. And a lot of them aren't going to be able to make it through. So they're going to be forced to sell or liquidate in a time that's maybe not a good time. So maybe expand on that. Maybe I didn't explain it perfectly. I feel like you said a lot more eloquently, but talk about that, how you view market cycles. Obviously, you have a very long-term perspective with your strategy, but for those that maybe are more opportunistic in their approach, how do you kind of play the cycle a little bit?
Yeah, I think, I thank you for that. That's helpful. I think a lot of people, and certainly not everybody, but a lot of people tend to look at a portion of the cycle in linear terms. So it's we all know cycles happen and they ebb and flow, but for whatever reason, when it's good, it'll never end. When it's bad, it'll never end. And that good and bad is really dictated by a third party telling us it's good or bad. So, and then it just rinses and repeats. So for us, there's benefits to both sides of the cycle, and in almost Newtonian, they're almost equal and opposite. So, in the run up that we just had, call it, I'll arbitrarily say 2017 to 2022, or, present, we had, to your point, we had free and easy money, huge increase in money supply, and that money was looking for a home. So cap rates, fell, prices rose, multiples rose. And so that was the benefit of that cycle, is you had an expansion in terms of multiples. But really the benefit of the cycle we're in now and going into is you have an expansion of the NOI, which at the end of the day is probably the most important part of the business. And so to the extent that your business, is able to pass on inflation to the customer, which, I would say is the sole and only definition of a good business, is whether or not a business can pass inflation onto the customer. If you can't, it's a terrible business. If you can, has merit. But the point is, if you can pass inflation onto the customer and you expect inflation to be at an elevated state, then you're saying, okay, to the extent that that can remain true, you have a business where, market forces, i.e. inflation, is going to do, let alone forced depreciation or other, other initiatives that you bring to bear that adds additional revenue, whether it's adding additional units, other line items of revenue, but all things being equal, the market is going to help you really grow your revenue. And so when you look at it in the whole and you kind of plug the two together, which is why we're long-term, because there's a lot of value that's unlocked by holding not through a cycle, but through cycle changes and having that long-term perspective. You might get from, let's take it from this cycle. You say you buy an asset today and you grow the NOI X% over the future. You might take $1 to $2 and invested capital through, NOI growth over that period of time. But if then you own that asset through the next expansionary, the multiple expansion time frame, when money becomes easy, interest rates are reduced, all of that, and values rise. The interesting thing is, prices typically don't regress. We pay, unbelievably, we all freely pay $5 to $7 for a gallon of milk, when we all remember when we grew up, there was 99 cents or whatever it happened to be, depending on when you were growing up. So
and you saying prices don't regress usually at a consumer level, right? Because obviously prices for assets can change, but as you kind of mark up prices at the consumer level, a lot of times they're not pulling them back even when the
Correct.
margins expand.
Correct, because people get used to it. They get used to the new. So if inflation comes and we're able to pass it on, our revenues should grow long into the future. And then when the market cycle shifts and goes from more, NOI growth to inflation to maybe lower inflation, higher growth, more multiple, I'm now getting a growing multiple on the already grown NOI. And it becomes, at $1 to $2 in the first cycle might go $1 to $4 because of the second additional cycle. And so and then you rinse and repeat that over multiple cycles, and it really gets pretty silly in a good way, which is then to our thesis, or not thesis, but our kind of a philosophy, which is, you sell bad assets, you keep good assets. Again, overly simplistic, but that's what we want to do.
Right. Inflation, as we've been saying for a while here on our podcast, is your best friend. At 8% inflation, the value of things will rise in dollar terms. It'll double every 10 years. And at 4% inflation is doubling every 20 years. So you think of 4% inflation is mild, but doubling in 20 years is a big deal. And especially if you're leveraged a little bit, well, the value of that asset doubles, but your equity way more than doubles. And the other thing is that people don't think about is the value of a dollar decreases. We all know that. But that means you get it on the debt side as well. The value of the debt is being eroded. And so if cash is on fire, inflation burns up cash, which it does. Well, then owning negative cash, which is debt, you want it burned up. And this is the big secret that our government knows. Just 6% inflation gets rid of 50% of the debt in 15 years. And so very few developed nations have defaulted on their debt. They simply inflate it away. And so it's the giant secret. And so again, you can get mad at these things and you can get upset, or you can play the game and play the cards you've been dealt. You don't like the price you're paying at the gas pump, we'll get on the other side of the gas pump. You don't like inflation, we'll get on the other side of inflation and let it work for you. And to your point, what the price of an asset, you don't determine, but the value of an asset, you can determine the value of an asset. Meaning, okay, you talk about NOI, that's net operating income, that's the profits generated, apart from debt service, it's the profits generated by that asset. If inflation is there and it's growing that asset, well, the value of that asset is going up, right? Now, the price of that asset, we're not in control of. It will come and go. All you got to do is wait for the next wave, right? And you got a negative wave. Okay, well, don't sell it. And you got a positive wave. Well, now you can entertain selling and make great returns. But yeah, inflation is, and long-term thinking and inflation is definitely a way to win in real estate.
Well said. Yeah, well said.
So Ryan, how do you as an investor, I mean, one of the challenges is this is easy to say, right? Everyone understands, contrarian investing in theoretical terms is a good, ideal, but it can be difficult not to succumb to emotions. And to your point earlier, through these cycles, the value of whatever asset we're talking about is usually dictated by some third party that probably has a bias, probably has, something that is, not a 100% pure motive. So how do you as an investor try to remove yourself from that? How do you think long-term? How do you evaluate something on the long-term when it's difficult in these kind of intermittent cycles, and not to just say, oh man, real estate's dropped by 30% over the past year and this is a new normal, so now we're going to have higher interest rates forever. And, it's, give us some perspective there as an investor with real human emotions. How do you kind of navigate through the challenges when you're trying to, you want to have some cash for reserves, but you don't want to have too much cash and let inflation erode it away?
Yeah, no, I think I guess to answer that, I'd go to say a couple of different things. But I think to the point, Bob just made, which I thought was really great, and clearly stated, I think having your own view, because I kind of to the point of your question, what I've learned is most passive investors delegate really fundamental decision making to third parties because they don't trust themselves. Not all, but a lot of them do. It's they're investing because their friend is, or their dad is, or their advisor. But very few of them say, I've looked at it, I like it, I'm moving forward, come what may. And ultimately, and we have that. We have an investor of ours who's an unbelievable guy. He's been in 5 of our funds. He's one of our early investors, and his first investment with us when I think I was 32. My wife was 29, which is really unbelievable now looking back. But his comment was, I believe in you, I believe in the model, and if I lose 100% of my principal, I'm okay with that, because not that it was that risky of a gambit, but to the point of making a decision, he had decided he was good with whatever the outcome was, and acknowledged the outcomes, which I like. But to the point is, having a view independent of third parties. So, understanding price and value, understanding, what long-term cycles can do to benefit you, but basically developing your own view and making your own decision, I think is important. And to that end, I think believing in yourself, and then, self-discipline, because it's, we all know, what it takes to lose weight. But our country obviously struggles with that. There's, the simple truths are simple and they remain simple. Doing them's hard because it takes self-discipline and commitment and all of those things. And, we as humans, myself included, struggle with that. So But I think those three pieces I think can help. Certainly not exhaustive, but
Yeah, I love that. Let's get a little more technical here, because I think one of the things that it's been really interesting in this year in particular, in 2023, is obviously inflation is a great tailwind for rent growth, so for top line revenue as a real estate owner, and that's gonna be one driver of NOI growth, right? You kind of have two levers: increase your revenue or decrease expenses. And that's kind of the natural thought. And hey, let's cheer on inflation. But the other side of it, which is the not happy part, is the expenses. And we're seeing massive increases in operating expenses of these assets. And to me, it seems like a lot of times the top line rents, because they are, you can adjust them to inflation pretty quickly, because, even on a multifamily property, your longest, cycle of locking in your rent is a year usually. So you have 12-month leases. And so you can adjust it at least annually, if not a lot sooner. You can mark to market faster, but the expenses seem to be a lagging, indicator here and they're now realizing that we're seeing massive increases in insurance and in payroll for the labor shortages. And obviously real estate taxes are going up as values have increased. So how are you, just as an operator, kind of managing through that? Because it feels like, oh man, my NOI is actually getting pretty compressed right now. Not only on debt service, and hopefully a lot of your deals have locked in interest rates, so you're not being impacted on that, but higher interest rates, higher insurance. And yeah, we're trending the top line pretty well, but hey, we also have a massive amount of new deliveries and multifamily especially, but we're also seeing some softness and absorption of self-storage and these other asset classes. So how are you kind of, getting real, technical right now? How are you kind of managing through this cycle in some of the more nuanced ways?
Yeah. So good question. So I'll hit the debt part first. So we're always long-term fixed, always. So, that made us somewhat unpopular probably in the last, 2019 to call it 2022, when you could get much lower if you did crazy things. And we said, no, we'll go long-term fixed. Now I'd say look brighter than we did then. But no, we're generally 5 to 10 years fixed rate debt. So we have a pool of assets right now. It's our fund 7, has about 300 million in assets in it. I think the average interest rate's like 4% fixed, with most of a lot of the loans fixed until 2030. So we're sitting pretty. I think our lowest rate's 2.5 in that pool. So we're always about fixing our debt. So we're not that exposed to, so it's low leverage and fixed rate. So no matter really what happens to the price of the asset, the multiple, or, we should be more than fine, have enough headroom, or what we call a margin of safety. To your point on expenses, the labor, our labor expenses have gone up, but are not gross. I mean, it's they haven't been overly severe. They've gone up incrementally, but we haven't suffered too much, because mobile home parks and storage do not require a lot of labor to operate them. And we have several, for example, we have about $60 million of mobile home parks in the Washington, D.C. metro, managed by one manager. So it's if hers goes up, it's insignificant to the overall performance of the assets. So we've seen a little bit there, not a ton. Insurance, to your point, has skyrocketed. And it varies by location, but the Florida properties certainly are seeing higher rates, and so we've had to get creative with insurance, without taking what we feel is too much risk.
Got it. Talk a little bit about just self-storage and mobile home parks as asset classes and what you're seeing. I think it's kind of a similar refrain we've seen in multifamily as well, where we've had a massive run up in rents the past several years. 2020, 2022. I don't know what the national numbers were on rent growth numbers, but they were extreme, outside of the mean. And now it's kind of slowing down a little bit. And now, because of that, a lot of new development came online, and those delivery, or the things that were started 2 years ago, are now coming online and being delivered to the market. And so a lot of predictions are saying, hey, over the next 12 to 18 months, absorption is going to be pretty slow because of a lot of the new product coming into the market. Meanwhile, we're already having a little bit of slowdown in rent growth, if not, negative rent growth. And so how are you kind of seeing that at a broader level across, your assets in self-storage? I mean, we have own assets that we own in this space, and obviously our listeners have self-storage investments as well. So what are you kind of seeing just kind of at the broad level in your portfolio?
Yeah, I think at a higher level, just kind of theme, I think these kind of times are when, the historical models are kind of stress tested, meaning, we have all tried to buy what we believe are quality assets, well located, as stated earlier. And I can go into more detail on what I mean by that. But when I'm sure you've seen the same thing over the last couple of years with the syndication kind of boom, where it's like every asset is unbelievable. And it's unbelievable because I said it is, kind of thing. And so there were a lot of tertiary non-optimal properties. And so the point in it is, that doesn't mean they're a bad property. It's just they may suffer a little bit more during economic cycles, like we're seeing now. So, for example, in storage, one of the big, actually number one on our checklist is are there barriers to entry against competition? That's number one on our list, and it's a long list, and every year it gets longer. But number one is barriers to entry. So, as an example, well, I can give you examples, but the point is it's high barriers to entry. So we have historically, we do not buy, and in the last couple of years, you and your listeners would have seen this in any market across the country, just the bevy of new storage being brought online, and generally in the outer rings of cities, kind of in the path of progress, building where they hope one day people will go and grow and live, and density will avail itself. And so we are much more inclined to buy a property very well located with very little land available for sale. They would almost have to buy a property, for another use, tear it down, and then build storage, which would make no sense. So very high barriers to entry, and good, dynamics in the market. And I can give more examples to this, but I say that to say, I saw an article in the Wall Street Journal, what is now yesterday, talking about kind of on the whole, how, and I presume they're talking about street rates, how street rates are down 20% from last year, which is interesting. Ours are not. We have some properties where we're discounting a little bit more, but not much. We're definitely not down 20%, but that's also the benefit of storage. Our average customer stays for 1,200 days right now. And so that's more than 3.5 years, let's say, on average. And so even if we have to discount, whatever it is, $1 a month or $50 move-in special, or 2 months free, or, one month free, any of those things, that doesn't preclude us from pushing rents 4 months from now. Because, to the point of annual, both mobile home parks and storage are month to month, which is great. So we can be really tight to the market, but we're not seeing, I am seeing a glut of, in some cities, there's a lot of new supply. Let's say Nashville is one, and there's several others. So depending on where, if somebody is invested in a storage facility, depending on where that property is in conjunction with new properties coming online, it could be soft for a couple of years. But it's really property by property based.
Yeah. And do you think a lot of it is the slowdown of absorption is due to new deliveries hitting the market, or is it also part of just in this in-between part of the economic cycle? Part of the thesis I've heard of self-storage is it does well in change, right? As the economy is booming, people are doing well, they're expanding, they're moving, upgrading to a bigger house, so they're having things in storage. Or in a down cycle, they're downsizing, they're putting stuff in storage because they don't have room for it because they're going to a smaller apartment or smaller house. Well, right now we're kind of in this weird in between, at the middle of 2023, where we haven't seen a recession and we have a lot of mixed signals, and it's still kind of a wait and see mode. Do you think that's also impacting some of that, slowdown in activity, or kind of both end?
I think that's fair. I think, yeah, storage benefits and kind of friction, people moving up, down, sideways, that all benefits storage. But to your point, right now, I think everybody's holding their breath, waiting to see, you consistently hear the soft landing is coming. We're going to achieve it. And I don't think most people believe that. So they're kind of, standing by, waiting to see. But I think storage will be fine. I think it'll be a great asset class in the long run. But I do think there's a lot of supply coming online, although, new supply is on the decline because cost of capital's up, material costs are up, and the softness that is being reported is, so that'll in turn, kind of help the next leg to be.
Yeah, no, I think it's a really important point because you think about all the new deliveries that are coming online, whether it's self-storage or whether it's multifamily. A lot of those were started a lot of times several years ago and, at a different point of the economic cycle. And so right now, the projects that are being started now, like multifamily, I'm using it as an example, it takes about 18, 24 months to actually bring, units online. And so it won't be until middle of 2025 before you're starting to lease those units. And right now we're seeing the amount of construction starts. So new projects kind of hitting the ground and getting going has kind of fallen off a cliff, which is to be expected because the cost of capital has risen so much. Banks are pulling back and really tightening the lending standards. And so for the next kind of 18 to 24 months, maybe absorption is slower because of all these kind of historical deliveries coming on the market. But if you're a long-term investor and you're investing in good fundamentals where there is kind of long-term demand in 18 to 24 months, I'm really excited about the projects I'm starting right now. It's a lot harder to get deals done right now, but I'm not going to have as much competition, down the road when I'm delivering those. So I think it's an important point to make because to your point, these expansions and contractions, they're not linear. And sometimes things we're seeing right now happen as a result of decisions a couple of years ago and vice versa.
Agreed. So there's a economist who's an interesting guy who most people will probably know well. And Jamie and I have become friends with him over the years, but his name's Ben Stein from, Bueller.
Sure. Yeah.
He tells a story of, this, he told Jamie and I over dinner a couple of years ago, the story of a house he bought in Beverly Hills. I think he bought it for $400,000, if memory serves me correctly. He ended up selling it for, I think it was roughly $2 million to a guy he thought was the greatest fool on earth, paying $2 million for that house. And that house, as it sits today, is worth over $8 million. So his comment was, I thought he was the bigger fool, and and he had right to think the same or something. It was funny. So the point is, on that house, let's say all that is, to my memory, accurate. If he bought it for $400,000 or $600,000, what would that change in the outcome?
Yep. Not much.
If you look at 400 and 600 and remove everything else, it's a huge difference.
Yeah.
And to that point, we're definitely not frivolous, nor are y'all in making acquisitions. It has to pencil, has to make sense, but ultimately you have to play the game. And there's a huge cost in waiting and thinking you have an accurate view of what's going to happen 2 years from now and waiting to that point. Because if you're wrong, it could cost you a lot. So, we're really big believers that you got to play the game. You got to put chips on the, should we call them chess pieces on the board? You got to put chess pieces on the board and play the game. So, and we just bought to that end, we just bought a property 3 weeks ago in Vero Beach, a storage facility. So we're still acquisitive, and we like storage. Bought one 3 weeks ago, and we think it's going to.
And theoretically, I mean, right now could be a great time to be buying, right? Because there is less competition because of the cost of capital, and it's not as frothy as it was before. And so if you're going after the quality assets, you might be able to get them at better basis.
Yeah. And if you look at the cycles, if 1 + 1 = 4 and kind of the multiplication of the cycles, then, there's, as long as you hold long-term, there's no bad time to buy. because you still get 1 + 1 = 4 to a degree. So yeah, I mean, there are transactions that are, there are times at which transactions are easier to come by. But for us, we're not trying to be market timers, because it's, maybe you could have waited a little bit, maybe not, but there's so much risk in being wrong. We want to buy good assets, well located, given the concept that there's just not that many good ones out there. So if you see something you really like in an area you really like, with a team that you like and a model that you believe in, the chance of something else coming anytime soon like that, there's not that many good deals out there. There just really isn't. So, I'm a big believer in just taking action and moving when you see something you like and living with it. And if you can't live with it, then, that has nothing to do with investing. And I'm not qualified to counsel on that, but that's something else.
Awesome. Any final thoughts? What do you where do we go from here, just as an economy, middle of 2023? I haven't checked the Fed minutes yet, but I'm assuming they bumped rates, probably, hopefully second to the last time or close to it. But where do you kind of see the cycle kind of going from here? Do you think we're going to get inflation under wraps, or are we holding on for a longer time?
Yeah, no, it's interesting. And to a degree, if you're a long-term investor, you really don't have a dog in the fight. It's more entertaining than, in terms of kind of the noise surrounding it. But yeah, if I were to give you my best guess, I think the Fed's going to have to see it through. So I think they're probably going to overdo things like they normally do. And it's a guardrail kind of management process. They're going to hit the guardrail and then bounce off and probably head to the other guardrail. I have no idea when that'll happen. But I think they'll over tighten, break a couple of things, and then, come to the rescue with, QE round 27, and, and then we'll, who knows? But I do think I don't think we're going to go back. I think the presumption is, as soon as the Fed pivots, we're going to go back to the high times of 2021 and 22. I don't necessarily buy into that, but I think it'll be more normative, kind of more boring, which is fine.
Yeah, that was probably the other side of the guardrail with, really cheap, easy money. And
right. I don't think going back there anytime soon is my guess. But I think sometimes people think we are, and they're holding their breath till that happens. But I don't think we are. And for what it's worth, to the point of our earlier discussion, if I had to pick which cycle we sat in the longest, I think the cycle we're in right now and going into, I wouldn't mind sitting in that longer than the other one.
Very cool. Well, Ryan, thank you so much for coming on and sharing some thoughts with us here, and definitely got a lot out of it personally, and appreciate you sharing with our listeners.
Yeah, and you bet. I always enjoyed time with you and Bob. I think highly of y'all. So thanks for including me.
Appreciate it. What's the best way for folks to kind of reach out to you, hear what you guys are doing at Elevation? What's the easiest place to get in the loop on the mailing list or otherwise?
Yeah. So anytime anybody can email me at ryan@elevationcg.com or elevationfund.com are the two.
I thought you were trying to keep things simple. You just give out your email address, but
yeah.
You're a very generous guy. So
we have no sales team, no sales.
Awesome. All right. Thanks so much. Really appreciate it. Thanks for coming on.
Have a good one.